How did a 30-year-old kid trick the world into giving him billions? Sam Bankman-Fried wasn't your typical crypto scammer. He was the MIT genius who convinced Tom Brady, politicians, and Harvard professors he was the future of finance. Until his $32 billion empire vanished in 72 hours, taking millions of people's life savings with it. What you're about to discover will change how you see wealth forever. Most people think Sam Bankman-Fried was just another greedy fraudster who got caught. They believe sophisticated investors and institutions are too smart to fall for obvious scams. They assume billion-dollar frauds require mastermind-level complexity that ordinary people could never pull off. They think crypto collapse was inevitable, and anyone involved deserved to lose money. But every single one of these beliefs is exactly what Sam counted on. The real story is far more chilling and far more valuable for your wealth journey, because understanding fraud psychology isn't just about avoiding scams. What if I told you the same psychological triggers that made people lose billions to Sam Bankman-Fried are the exact triggers that destroy most people's wealth? What if the difference between financial freedom and financial ruin isn't intelligence or luck? What if it's simply knowing how to see through illusions that everyone else believes are real? By the end of this video, you'll possess knowledge that puts you ahead of 90% of investors. You'll understand the hidden patterns that separate Luxonians from victims, and you'll never look at investment opportunities the same way again. Sam Bankman-Fried was born into academic royalty at Stanford University. His parents were both Stanford Law School professors with connections to the highest levels of power. He graduated MIT with a physics degree, proving his intellectual credentials. At 22, he joined Jane Street Capital, one of Wall Street's most exclusive quantitative trading firms. Within 3 years, he was making millions in arbitrage trades most people couldn't even understand. In 2017, he founded Alameda Research, exploiting price differences between crypto exchanges. His first trade made 10% profit in 10 minutes, netting his firm $20 million. By 2019, he launched FTX, positioning it as the responsible crypto exchange. Unlike sketchy competitors, FTX looked professional, corporate, legitimate. By 2021, FTX was processing $10 billion in daily trades. By 2022, Sam was worth $26 billion and living in a $40 million Bahamas penthouse. He was dating Caroline Ellison, a Stanford economics graduate who ran his trading firm. Together, they convinced the world they were the adults in the crypto room. But behind closed doors, they were running the largest financial fraud in history. Here's how Sam built his empire of deception, using principles every Luxonian needs to understand. First, he weaponized credibility through strategic partnerships. FTX didn't just buy advertising, they bought legitimacy. They paid $135 million for naming rights to the Miami Heat arena. Tom Brady and Gisele Bündchen became paid spokespeople, lending their reputations to the brand. Larry David starred in their Super Bowl commercial, joking about missing out on great opportunities. The message was clear: only idiots would miss the FTX revolution. Second, Sam cultivated the image of the reluctant billionaire philanthropist. While other crypto bros flaunted Lamborghinis, Sam drove a Toyota Corolla. While others wore designer suits, Sam wore cargo shorts and wrinkled t-shirts. He slept on beanbags in his office and talked about giving away his entire fortune. This humble image made him seem trustworthy compared to flashy competitors. Third, he bought political protection through strategic donations. Sam donated over $40 million to politicians, becoming the second largest Democratic donor in 2022. He testified before Congress as the voice of responsible crypto regulation. Politicians praised him as the kind of crypto leader America needed. Fourth, he attracted institutional money through social proof. Sequoia Capital, Silicon Valley's most prestigious VC firm, invested $150 million. The Ontario Teachers' Pension Plan invested $95 million of retirees' money. When institutions this sophisticated invest, others follow without asking questions. But here's where every Luxonian needs to understand the mechanics of financial manipulation. Sam wasn't running a crypto exchange. He was running a personal ATM funded by customer deposits. When you sent money to FTX, it didn't stay in your account. It went straight to Alameda Research, Sam's private trading company. Sam used customer funds like his personal piggy bank. $200 million for Bahamian real estate, $100 million in political donations, $40 million for a private jet, $15 million for his parents' house, millions more for personal expenses, vacations, and failed investments. When customers tried to withdraw their money, there was an $8 billion hole. The balance sheets were fabricated. The audit reports were fake. Customer funds that legally should have been segregated were gambled away on risky trades. When crypto prices crashed in late 2022, Sam couldn't meet withdrawal requests. Customers who thought they owned cryptocurrency actually owned IOUs from a bankrupt company. In 3 days, FTX went from a $32 billion valuation to complete bankruptcy. 8 million customers lost everything overnight. But here's the question every Luxonian must answer. Why did the smartest money in the world fall for this? The answer reveals the hidden psychology that controls most people's financial decisions. First, the halo effect of elite credentials. MIT physics degree, Jane Street experience, Stanford family connections. These credentials created an unconscious assumption of competence that bypassed critical thinking. People didn't investigate, because they assumed smart credentials meant smart decisions. Second, social proof amplified by FOMO. When Sequoia Capital invests $150 million, it signals to other investors that the opportunity is legitimate. Nobody wants to be the one who missed out on the next Google or Apple. FOMO overrode due diligence. Third, the power of moral camouflage. Sam positioned FTX through the lens of effective altruism. He claimed he was making billions specifically to save the world. This moral mission provided ethical cover for aggressive risk-taking. Investors believed they were funding a noble cause, not a criminal enterprise. Fourth, confirmation bias in a bull market. When crypto was rising, every risky decision looked like genius. People saw what they wanted to see and ignored red flags. Fifth, the illusion of diversification. Investors thought they were diversifying by using different crypto platforms, but many platforms were connected through the same underlying infrastructure and counterparties. When FTX collapsed, it triggered a cascade that destroyed seemingly unrelated investments. Every generation produces its master manipulator, and every generation thinks they're too sophisticated to fall for it. In the 1920s, Charles Ponzi convinced investors he could generate 50% returns in 45 days. His scheme collapsed when new investor money couldn't keep up with payout promises. In the 1990s, Bernie Madoff ran a $65 billion Ponzi scheme for 20 years. He convinced country clubs and hedge funds he had a secret Wall Street formula. When the 2008 financial crisis hit, withdrawal requests exposed the fraud. In the 2000s, Enron convinced Wall Street they were revolutionizing energy markets. They used complex accounting to hide debt and inflate profits. When investigative reporters dug deeper, shareholders lost $74 billion overnight. In the 2010s, Elizabeth Holmes convinced Silicon Valley she could revolutionize healthcare. Theranos raised $945 million based on blood testing technology that never worked. Each fraud followed the same psychological pattern Sam Bankman-Fried perfected. Brilliant founder with impeccable credentials and prestigious background. Revolutionary business model that few people fully understood. Impressive roster of investors and advisors providing social proof. Financial results that seemed almost too good to be true. And most importantly, a compelling story that made people want to believe. But here's where Luxonians develop an unfair advantage over 90% of investors. We understand that sustainable wealth isn't built on revolutionary breakthroughs or secret formulas. While others chase the next FTX or Theranos, we focus on time-tested principles. Real wealth comes from owning productive assets over long periods of time, not gambling on trendy investments that promise overnight transformation. When someone promises guaranteed returns with no risk, that's your signal to walk away. When everyone says this time is different, remind yourself it never is. When a young genius claims to have revolutionized finance, ask for independently audited statements. The most dangerous threats to your wealth aren't obvious scammers in dark alleys. They're MIT graduates in cargo shorts claiming they're saving the world. Sam's victims weren't stupid people who deserved to lose money. They were intelligent individuals who let greed cloud their judgment. They abandoned basic due diligence because they didn't want to miss out. They trusted prestigious credentials over verified character. They believed compelling stories over boring balance sheets. Here are the red flags that could have saved FTX investors billions of dollars. Financial statements that aren't audited by reputable, independent accounting firms. Customer funds that aren't segregated from company trading accounts. Investment strategies that can't be explained in simple terms. Founders who spend more time on social media than running their actual business. Heavy spending on celebrity endorsements instead of focusing on the core product. Regulatory investigations that are dismissed as attacks by the establishment. Management teams with impressive credentials but no relevant industry experience. Business models that require constantly attracting new investors to pay existing ones. Any investment opportunity that pressures you to act immediately or miss out forever. Remember, legitimate investments don't have expiration dates, but scams always create artificial urgency. But here's the deeper truth every Luxonian needs to understand about the power of focused belief. Sam Bankman-Fried possessed an incredibly powerful vision of his future identity. He saw himself as the savior of cryptocurrency and the philanthropic genius who outsmarted traditional finance. This vision became so real in his mind that he started living as if it were already true. And here's where psychology reveals something most people never consider. When you believe something deeply enough, your brain starts filtering reality to support that belief. Psychologists call this confirmation bias, but it goes deeper than that. Your subconscious mind will literally reshape how you perceive information to maintain consistency with your self-image. Sam's identity became so tied to being a visionary genius that contradictory evidence became invisible to him. True Luxonians understand that belief shapes perception, but perception isn't always reality. We use vision as a compass for direction, not a filter that distorts what's actually happening. We align our daily actions with our long-term identity, but we measure progress with objective data. Sam's self-image made him believe normal rules were obstacles for ordinary people, not principles that applied to visionaries like him. Customer money became his money because geniuses deserve resources to change the world. Other people's financial futures became acceptable sacrifices for his greater mission. This is the shadow side of identity-based thinking, without ethical boundaries. When your self-concept becomes more important than other people's well-being, you've crossed into dangerous territory. So how does a Luxonian protect themselves from the next Sam Bankman-Fried? Here's where we take a contrarian approach that most people won't understand. We don't invest in cryptocurrency at all, and here's why. We understand cryptocurrency's value proposition perfectly. You can transfer $1 billion anywhere in the world instantly. You can access your wealth from any location with just a seed phrase in your mind. We get the revolutionary technology and the freedom it represents. But we also understand why Warren Buffett doesn't invest in gold. Gold doesn't produce cash flow, dividends, or growing earnings. It just sits there hoping someone will pay more for it tomorrow. Cryptocurrency is the same. It's digital gold without the physical backing. Instead of speculating on assets that don't produce income, we focus on cash-flowing businesses. We invest primarily in broad market index funds. When you buy an index fund, you own pieces of hundreds of companies. These companies have employees working every day to increase profits. They produce products, generate revenue, and return cash to shareholders. That's truly passive income. Other people working to make you money. Real estate isn't as passive as people think. Maintenance costs, property management, taxes, and repairs eat into returns constantly. Those tax benefits everyone talks about? You're just spending money to save money. If you're not maintaining your properties, you become a slumlord. If you are maintaining them properly, those costs offset most tax advantages. Index funds require no maintenance, no midnight phone calls about broken pipes. The companies inside them handle all the operational complexity for you. Now, if you absolutely must speculate on high-risk assets like crypto or individual stocks, follow this rule. Only invest money you can afford to lose completely without affecting your lifestyle. If losing that money would impact your rent, food, or family, don't invest it. Treat speculation like entertainment. Set a budget and stick to it. And most importantly, remember that your character and integrity are your most valuable assets. Sam had intelligence, elite connections, and access to billions of dollars. But he destroyed everything because he compromised his integrity for short-term gain. When Sam finally faced justice in a Manhattan federal courtroom, the illusion completely shattered. Prosecutors presented evidence of customer funds used for luxury real estate purchases. They showed documentation of company money spent on Sam's personal expenses and political donations. His former employees, including ex-girlfriend Caroline Ellison, testified against him under oath. She described late-night conversations where Sam admitted he was in serious trouble when customer withdrawal requests exceeded available funds. The jury needed only 4 hours of deliberation to reach their verdict. Guilty on all 7 counts of fraud and conspiracy to commit fraud. Sam's parents cried in the courtroom as their son was sentenced to 25 years in federal prison. The former billionaire who once commanded a $32 billion empire will spend the next quarter century behind bars. Meanwhile, his victims will spend the rest of their lives trying to recover their stolen savings. But here's the most important lesson for every Luxonian watching this story unfold. Sam Bankman-Fried didn't fail because he lacked intelligence or business acumen. He failed because he confused raw intelligence with practical wisdom. He had the intellectual capacity to build billion-dollar businesses from scratch, but he lacked the character and wisdom to build something sustainable and ethical. Intelligence can help you identify opportunities and make money quickly. Wisdom helps you preserve wealth and sleep peacefully at night. Intelligence can help you spot market trends and capitalize on them. Wisdom helps you recognize traps and avoid devastating losses. Intelligence might make you wealthy in the short term, but wisdom creates lasting prosperity that benefits multiple generations. Sam possessed MIT-level intelligence, but demonstrated kindergarten-level integrity. And in the long run, character and wisdom always triumph over cleverness and manipulation. The sophisticated investors who lost money with Sam weren't really investing in cryptocurrency technology. They were gambling on a compelling story told by a charismatic young man they barely knew. The institutions that poured billions into FTX weren't buying into revolutionary financial infrastructure. They were buying into the myth of genius and the fear of missing out. Don't invest your hard-earned money in stories, no matter how compelling they sound. Invest in productive assets with long track records of generating real value. Don't gamble your financial future on personalities, regardless of their credentials or charisma. Build lasting wealth through proven principles that have worked for generations. The difference between Luxonians and everyone else isn't access to secret information or exclusive opportunities. It's the discipline to see through illusions that trap most people, and the patience to build wealth systematically over time. If this video opened your eyes to how successful people think differently about risk and opportunity, make sure you subscribe and hit that notification bell for more wealth-building insights. Check out the Luxona Vault, where we reveal the exact strategies millionaires use to protect and systematically grow their wealth over time. Because while everyone else is chasing the next big thing and falling for the next big scam, Luxonians are quietly building the next big fortune. Remember, in a world full of Sam Bankman-Frieds promising easy money and revolutionary shortcuts, be the Luxonian who sees through the illusion and builds real wealth. Welcome to Luxona, where millionaires are made.